Thank you for joining us in this evening webinar. We do have a good number of people who are listening in right now. Let's give our participants a few more minutes before we begin formally. Good evening, ladies and gentlemen. My name is Whitney. I'm part of the wider mortgage strategy team in HSBC Singapore. On behalf of my fellow colleagues and our external speaker, a very warm welcome to all of you to today's webinar. The topic of the day will be on property outlook for the second half of 2025, shared by our distinguished partner, Saville Singapore. I am extremely grateful for the opportunity to be here with all of you today. Many of you have partnered with HSBC. Some of you have been our clients for a long time. Thank you for giving us the opportunity to serve you and your family. HSBC is Southeast Asia's longest serving bank, with our presence dating back to the 1870s. We are proud of our heritage and we understand the importance of long-term partnership. We want to continue to partner with you in the decades to come. I trust this evening's insights will help you to navigate Singapore's property landscape for the remaining part of the year. It's a pleasure that we have the opportunity to convene at the second half of the year today. After a series of record-breaking sales, Singapore property market faces a big question. Will prices continue to rise, or will new cooling measures provide some relief? As such, we are joined this evening with our distinguished speaker from Saville Singapore, Alan Cheong, to answer such questions. Alan is currently the head of real estate research and consultancy at Saville Singapore. He joined Saville in May 2011 as executive director, leading the research and consultancy team. With over 20 years of experience in real estate, he has expertise in research, project financing, and property equity study, both locally and regionally. His career began in 1990 with the URA, Urban Redevelopment Authority, focusing on property market forecasts and government land supply policy. Do take the time to listen to Saville's insights, and also feel free to ask any questions that you may have in the Q&A section. While time may be limited, we do our best to get to your question at the end of the webinar. Let us now welcome Alan Cheong. Over to you, Alan.
Thank you, Whitney. On behalf of Saville, I would like to thank HSBC for this opportunity to present our views, and I would like to thank everyone, all the participants who can spare this time of the evening for to hear me out. And without any further delays, I will give you a rundown on the Singapore private residential market for the rest of this year. And you may ask me questions later about what I think about what the drivers are and what you have in mind with regards to this segment of the market. So we start with the usual disclaimers. Right. So this is the HSBC Bank's disclaimer. And then this is Saville's disclaimer. Right. And now we get down to the presentation proper. Singapore's population, I'm sure you know, is about 6.04 million. And total household wealth in Singapore runs at the last account that we have from our sources is US 2 trillion. And as I'm not going to run through all the numbers, but you know that Singapore is a pretty wealthy nation, not only by regional standards, but by global standards. And here in Singapore, 91% of households own their homes. Only about 8.5% are rented homes. So in total, we have about 1.33 million households that own their homes. And in 2024, total households in resident households is 1.46 million. And resident means those who have stayed in Singapore for more than 90 days at a stretch. And property measures, there's quite a few property measures, so innumerable that it's hard to really pin them down one by one. And it's also non-exhaustive because sometimes there are measures which you really can't put a finger on it. Is this a measure or is this what does this mean? So as far as we are concerned, if there had been no measures, I think Singapore property markets would have performed, the residential market prices would have outperformed even Hong Kong's price increase. The overall sales trend is will be, I will talk about it. But before that, I would like to break down how the URA parcels out Singapore's residential market. So at the bottom, you have the luxury segment, CCR, core central region. And these are the areas that are colored in orange, blue, and pink, right? Pink is Sentosa. And then the districts for the CCR are 1, 2, 4, 6, 7, 9, 10, 11. Some of these districts, CCR doesn't cover the entire districts. For example, District 6, it only covers some parts of it only. Then Beach Road, same thing. It doesn't cover the entire stretch of Beach Road. Then RCR, mid-tier, that is rest of central region, they are the areas bounded by the black line, the dark bold black line, but exclude the colored regions. And these are districts 2, 3, 4, 5, 6, 7, 8, 12, 13, 15, 21. So on the left, you see Clementi Road. On the top, you see Ang Mo Kio Avenue 1. And then on the right, you see Eunos Link. And then finally, we have the mass market segment, OCR, outside central region, and it's the areas outside of this bold black line. So we look at the overall sales, and we look at new launches first. New launches are those highlighted in the yellow bar chart. And you find, you notice this, that new launches and new sales, they tend to pair up pretty well. It tells you a lot about the market here, because this chart really infers that there's some measure of control on the launches. And who is controlling it? Well, as you know, Singapore, most of the lands that are now sold are from the government. So it is the government, like the URA, that looks at the project's demand and then supplies enough land to meet those demand. And Singapore's land policy is not like in many countries where it's free market. So, you can be rest assured that the chances of an oversupply situation occurring here is very low, because the URA is monitoring the supply situation. So whatever gets launched, you find that the red bar is there. It is sold. If you launch lesser, it gets sold, less gets sold. If you launch a lot like 2021, 2020, the demand is also there. So I think this tells you that our market is very different from what you expect from overseas. In overseas markets, you don't have this situation. So you are at the whims and fancies of developers who jump the gun, and then knowing the market is hot, they launch a barrage of supply, and you can't find the demand. And price-wise, it's like this profile. This is the URA property price index. It's risen quite a lot, 56% from the second quarter of 2017 to the second quarter of this year. By regions, the CCR, the luxury segment, is the yellow line, then followed by RCR, mid-tier, and the mass market. You'll notice immediately that you'll find the mass market and the mid-tier market prices have outperformed the luxury market. But starting from the third quarter of this year, as you know, they have launched a couple of developers like Wing Tai, have launched Riverside Residences, and then Promenade by Promenade by Wing Tai. Sorry. So Fraser's also launched Robertson Opus, and these projects have found very strong take-up. And we'll expect that in the second half of this year, you will find that the yellow line will probably be trying to catch up with the RCR and the OCR prices. And in terms of buyers by nationality, most buyers are still Singaporeans. And with the imposition of the 60% ABSD on foreigners since the second half of 2023, foreign demand, the red line, has been very, very low. And by nationalities, this includes PRs. It's been quite consistent since 2024. Majority of the buyers are still from China. So every quarter, you find that they hover between 29 to 31% for the past 1 year. Then followed by Malaysians and then those from India. Okay, we'll look at the luxury segment. Price-wise, the yellow line is for new launches. We did not adjust for, project attributes. So this is just the median price for the resale markets and the new sale market. If there are no project launches in the CCR or whatever segment of the market, you'll find that sometimes transaction numbers are very low, and particularly for the CCR, the prices may exhibit more volatility. So we see that in the first Q, prices actually came out quite a fair bit, and then in the second Q, it rebounded. In the third quarter, with the launches that I mentioned earlier in the CCR, this thing may just rebound back up again. I mean, or at least maintain a positive trend. But you'll notice that there is a big gap to the resale market. That's the black line below. And that exists the opportunity for arbitrage, meaning not in the sense of, like if you're trying to arbitrage a security, but you could find value for money in the resale market for the CCR, core central region. And this chart shows you two things. The bar chart shows you the number of units transacted for what at Salvos we call super luxury non-landed properties. These are priced $3,000 per square feet and above. Numbers are low, but you look at the red dots on top, they represent the maximum price achieved in a particular quarter. And the prices have been very resilient. For example, the second quarter, we see a $6,013 per square feet transaction. Right? And once in a while, you'll see prices pushing towards the 7,000. And for the luxury segment, again, buyers are mainly Singaporeans, then followed by PRs, very few foreigners. The mid-tier segment has this price profile. Now, more launches in the mid-tier segment because there are many government land sales in this mid-tier and the mass market segment of the private residential market. So we see less volatility in the past 2 years because of these GLS government land sales being launched. And the prices have taken an uplift or upturn, accelerated in the second quarter of this year. And new sale prices are averaging $2,900 per square feet in the second quarter. Right? And in the resale market, the prices are about $1,900 per square feet. That's the dark line below. Again, most buyers are Singaporeans, followed by PRs. For the mass market, prices exhibited a bit of volatility. Why so? Because if you look at the mid-tier market, the chart or the map I show you, it's bounded by the black line. So inside the black line, it's pretty well concentrated. There's a concentration of amenities and public transport systems that you really can't differentiate between one part of left side of the RCR of Singapore Island to the right side, which is Eunos. So prices there are pretty homogeneous. But in a mass market, it's the rest of the island. And sometimes you may have projects that are launched in areas which are less well served by public transport system. And so you see prices bounce around like the yellow line on top. So resale market, pretty consistent, has been trending up. Again, hardly any foreigners buying the mass market. Most are Singaporeans and MPRs. Okay, future supply is this. This year we are expecting about 6,000 units in total. So for the second half, we are left with about 2,600 units that will be completed. These are not launches. These are completed units ready and fit for habitation. Next year, numbers will rise to 7,000, and then the peak will be about 2029, 11,000 units. But as you go further down the line, right, developers may not be so precise as to complete the project by 2027. There's usually some buffer, and so those by 2027 may spill over, some of them to 2028, and the projects slated towards the end of 2028 may spill over to 2029, and so on and so forth. Leasing market numbers are pretty consistent. This year, for the first half, numbers are slightly above last year's first half. And I think in the second half, you still see numbers pretty strong too. And rents been pretty stable despite the concerns about tariffs, despite the concerns about slowing economy, regional volatilities, etc., etc. But rents have been holding up pretty well. So our outlook is this: what is driving Singapore's private residential market? And I'm sure it's something that everyone is always asking, particularly after a weekend launch, right? And you say, wow, 94% sold. Who's buying? I think there's a lot of demand out there, and that stems from the baby boomers generation. This chart is derived from the top line, is the liquid assets per household, which I take from the household balance sheet. I just take the liquid assets and I divide by number of households in Singapore. Then the bottom line, the darker line, is the URA private residential price index. And then you look at the gap. The household liquidity has been rising faster than URA price index. So if you just look at these statistics, there's actually housing in Singapore is not that expensive insofar or from a liquidity measure. So there is liquidity in the system. Now, we can't look at the median household income to compare that with median prices in properties, private residential properties here, because there are only about 30% of the total housing stock in Singapore that's in private hands. But median income is 50%. So it doesn't really cut it. You have to really look at the top 30 percentile of the populations or household earning capacity and match that with housing prices. So we may say that while the Urban Land Institute published a ratio, median house prices for apartments divide by household median income, the ratio is 16.9 times. But you can't use that because you're not comparing like for like. Because at the 50th percentile of the household spread, it lies in the HDB gap, you see, in the HDB segment. It's not in the private segment. So you don't use median to compare. I think a lot of people are making that mistake. Okay, then you have the liquidity. Where does it reside in? Which age group? The top and the bottom are just age groups of population split profile by in 2024 and a projection by the year 2030. It's about the same kind of profile pattern, right? But it is those in the 60th to 70 years old gap that grew up in double-digit economic growth and double-digit income growth, and in the top 20 percentile of our decile of our household that has the liquidity. So don't use median. You have to actually use the top income bracket because you're talking about private residential properties and not HDB. So that group, it's because of the baby boomers generation, it is peaking. That's where the money is. And the money is in the savings of these guys who've taken back a CPF, and out of fear that their children cannot afford to buy a private residential property, they take that sum as a down payment for their children, and their children will then use their monthly income to pay for the mortgage. So that's where the transfer of wealth is, right? So that's from the baby boomer generation. And I did this, I didn't want to construct a model using Excel, so I fed in the assumptions and the variables into AI and let generative AI project for me the age group breakdown all the way to the year 2050. And the red bar, those are age 50, 65 years old or older. That's increasing over time. So when it increases, it refers to that group of people who have already taken back their CPF. And that is increasing, expected to continue increasing to 227, 228, and going on. So the money is coming from that group to feed one segment of demand in the private market. Then the other is from the HDB upgraders. 2025, you see quite a low number of HDB BTO flats that have reached a 5-year minimum occupation period. So what it means is there will be a relative lack of supply from new flats that have hit 5 years, and people can then sell it and upgrade. So because of the paucity of or scarcity of supply, it will drive HDB prices up. And we're already seeing that, right? Record prices are being broken in Bukit Merah and Bedok. And that is the second group of buyers, upgraders. And these upgraders are the ones taking the 3-room flats. Whereas the parental support type from the previous, from this, refers to people buying using the children's name to buy for 400, 500, 2-bedroom, 700 square feet apartment. That's mainly from this group. So this group, the upgraders of HDB, they will buy the 3-roomers. And so across the spectrum, from studio to 3 rooms to 4 rooms, there is demand coming from what I've mentioned earlier, the HDB upgraders and also parental support monies. This year, in an earlier seminar, I gave a projection, a wide range of -1% to 7%, predicated on whether there will be cooling measures and when it comes about. Now we saw a cooling measure, the extension of the seller stamp duty to 4 years, and we have tightened our forecast for this year to 3 to 5%. So first half of this year, we saw 0.7% increase in first quarter, and then another 1.71% in the second quarter. So first half, we already in about 1.8, 1.9%. So we will see another 2% or more for the second half of this year. Next year, I think prices will still rise by about 3% because there's still a lot of money from the baby boomer generation waiting to be deployed. So I guess I end my presentation here. If you have any questions, you can just ping over. Thank you.
Thank you, Alan. It's indeed an insightful sharing that I'm sure many of us will have quite a number of takeaways from this session. We are close to the end of our webinar, and we have a few more minutes to take in some questions from our participants listening in. This is a great chance for you to raise any questions that you may have on the topics that were discussed earlier on any of the recent government announcement. We'll try our best to cover as many as possible. Do type in your questions in the chat box, and our team will be selecting the questions for Alan or myself to answer. There is quite a number of questions that we have here. So without further ado, the first question for Alan. Do you expect the government to further introduce new property cooling measures or to relax some of our existing property cooling measures that are in place?
I think with the recent recalibration of the seller stamp duty from 3 to 4 years, probably we'll just take a pause for now. For them to relent and reverse to liberate the market further, I think that is very unlikely, given the fact that we have seen very strong take-ups for new project launches in the past month or so. So it will take a while.
Okay, thank you. The second question that we have over here, what is the impact of the continuing headwinds arising from the global trade conflict on the property market?
Yeah. Okay, so this is very interesting because normally you expect, right, that when you have global uncertainties, and that you probably hark back to 1990 during the first Gulf War, people are afraid and property prices reacted to those fears. But today, I think Singaporeans have been pretty inured, meaning pretty mollycoddled within our system to the point where they read about it, but they don't think that the problems are going to be coming to our shores. So we see MNCs on the office leasing side exercising extreme caution. So are the industrial users. But on the other hand, uh, you have very strong take up, buying power for new launches. And these new launches were sold at record prices. And the only way I can explain it is the Singaporeans within a narrow band, say within one standard deviation. This is abstract now. Within one standard deviation to left and right of what they are used to every day sitting in their office or retiring at home, they see volatilities. But the more you bounce around within that band, the more get agitated to take the money out to buy a property using the children's name, right? You fear the kids are fearful that, or the parents are fearful that AI will take their jobs. So what the parents do? The parents we think are likely to take the money out to buy a house for them, a down payment. So that explains the Singapore psyche. It's very different from what you see overseas, where people are more reactive to geopolitical situations or events.
Oh, wow, that's really an interesting one. Okay, thank you so much, Alan. The third question that we have over here, right? What do you think are the main drivers behind the sales trend that you shared for the first half of the year?
Okay, there will be in the first half of the year, um, the number of launches were pretty in patches. Some had unique sales attributes, like in an area that had not seen any major launches, say in the Tampines area for a long while, and then you bomb the market with one project and it gets a very strong take up, even though prices were at record highs for that area. Then there were projects that were launched which were pretty far from the MRT,
Mm-hmm.
and then the takeouts was pretty lukewarm. And then finally got one in at the science park, and because they had this, at the science park, it's easy to promote the story or push the story that you can rent your apartment to the tech workers or the science workers working in the science park, and people sort of buy that idea. And it's also very near the MRT. So the drivers have been project by location with unique selling point, projects with unique selling points doing extremely well. Those are just mediocre side attributes, they did 30%, 40%. And then you have projects that did very well at 90%. Again, if you projects with in areas that have not seen any major launches. So those were the major drivers. And the money that fed it was, again, I mentioned the baby boomers and HDB upgraders.
I see. Thank you so much. Um, okay, we have one over here. What is the current mortgage rates offered in the market? Okay, this one will be for me. Okay, the choice, we do actually have a choice of fixed or floating packages. We fixed rates ranging from about 1 to 3 years. Okay, and float rates that's like pegged to 1 month or 3 months. SORA. Okay, we do have preferential rates for our premier clients. Okay, this is really and we have a feature that's unique to HSBC, which will be interest offset packages. This will help you to save interest as you pay off your loan faster. Okay, our rates do start from about 1.92%, okay, per annum. So if you do have any further questions in terms of our interest rate packages, do feel free to reach out to your relationship managers if you'd like to find out more. Okay, yeah. The fourth questions that we have over here, right? Yeah. What is for Alan? What is the difference between new sale, resale, and a sub-sale unit?
Okay, new sale means like over the weekends, right? You saw projects that was launched. There was one by
Fantastic sales.
Land. So that's a new sale, right? You buy off plan. And it also refers to projects that are not completed, not yet deregistered, meaning it hasn't been deregistered. The company has been not deregistered. The developer has not deregistered the company for the project. So you can take it as roughly those that have not hit CSC completion or TOP CSC. That's new sale. Once it is completed and deregistered, even though it is a sale by a developer, it is considered resale. That's how the URA classifies it. It's resale. So at one project was like OUE Twin Peaks many years ago, completed. There was no ABSD back then. So the developer could hold the project and then sell it longer, take a longer period of time. So it was registered as resale. And what is subsale? Subsale is someone that buys off plan before the project is deregistered, sells it. Now, with the seller stamp duty extended to 4 years, it's very difficult to flip now and make a profit. So you will see, forget about subsales moving forward, because the 4-year seller stamp duty holding period means you are unlikely to flip it out within the period in time. So just focus on new sale and resale.
Yeah, I understand that as well. The next one, how is demand projection increasing continuously when population cohort is not? Assuming all local buyers, surely there will be a tailing off on demand for residential.
Yeah, good question.
Good question.
As of now, if they reverse, this increase in population by extending the invitation to foreigners to come here to work, and getting PR, or issuing new citizenship to foreigners, until they reverse that policy, then we may see an end to it. But I don't see an end to that so soon, right? You may have your views that today you may be a talent, but with AI, tomorrow you are not a talent, but then you are in the system already. But that's besides the point, you see. But as of now, that policy is still in place. The baby boomers' money is still there. The baby boomers' money will run out, right? You cannot just say, all those 60 to 70 years old will have money. Those 60 to 70 years old today will have money. But those 40 over years old, when they move to the 60 to 70-year-old group, they may not have money, because very soon those in the 40 to 50 may be displaced by technology and they face structural unemployment. But now, at least for the next couple of years, the cohort 60 to 70 grew up in an era where they saw very high income growth, and they did not really face that much structural unemployment. So they have the wealth. So I would think I would look it in a rolling 3-year, with a rolling 3-year view. So the rolling 3-year view is still pretty okay.
Okay, thank you so much. Yeah, we do have one last question for now. Okay. I have an existing mortgage with another bank, and I'm interested to find out more on what HSBC can offer for refinancing. Who can I reach out to? Okay, that question will be for myself as well. Speak to your relationship manager to work out the potential interest savings that you may have when you refinance over to HSBC. Okay, do check in with your relationship manager. Let us know so that we can help further. Okay. Yeah. So that would be the last question that we have for today in this limited time. Okay. I hope you have enjoyed this session and found the information valuable and insightful for you. There was so much that Alan has covered in the last half an hour. Thank you so much once again. If you do have any questions that Alan did not manage to answer, or you want to find out more on our mortgage offering, please feel free to reach out to your relationship manager. Thank you once again, Alan, and thank you once again, everybody, for your time and participation today. Wishing all of you a smooth and steady rest of the year ahead from all of us here at HSBC. See you next time.
Good evening.